The market feels incredibly volatile right now, and some investors hate this. But what if this is exactly what we want as investors and the volatility is actually able to tell us exactly when to invest? Well, perhaps this is possible, and perhaps this is the best way to invest. There is this indicator out there. If you haven't heard of it, it's called the VIX indicator, and it may just be the perfect tool to tell you when to invest your money. But of course, let's discuss. It's a measure of the level of implied volatility, so not the statistical nor historical volatility. And it's based on the S&P 500 index options. It gauges how much the S&P 500 could fluctuate over the upcoming 30-day period. And generally speaking, the S&P 500 gives a picture on the global market. Although it's focused on options, it does give a general measure of the expected volatility of the US stock market. And by the way, volatility here means how intense the market is swinging either up or down. This indicator is also often referred to as the investor fear gauge because it reflects the investor's best predictions of the short-term market volatility or risk. So how much an investor thinks the market will fluctuate. Greater volatility just means that the individual share or index itself is experiencing bigger than average price changes, higher or lower over a short period of time. A high VIX is suggestive of investors' fear, and a low VIX indicates complacency. So what can investors learn from the VIX? When there's a spike in the VIX, it just means that the traders in the S&P 500 options market are expecting an increased volatility. The higher the VIX index, the higher the fear, and this is generally considered as a buy signal. And we all know that the good old investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." And of course, the reverse is also true. The lower the VIX, the lower the fear, which indicates a more steady and complacent market. For others, high market volatility is not such a buy signal, but it more is a prompt for them to start shifting around their portfolio and moving towards more stable assets such as bonds. So let's now take a look at some of the times that the VIX indicator has actually gone up, and we'll take a look to see how that has impacted the S&P 500. Little back test, if you will. So here is a really interesting graph showing the link between the S&P 500 and the VIX indicator. And you can see that in blue we have the VIX index, and in orange we have the S&P 500 index. Typically speaking, if the VIX goes above 30, this is considered to be heightened volatility, a signal of heightened volatility. And this is often coming from increased uncertainty, risk, and investors' fear. And when the VIX values go below 20, this is typical of a stable, less stressful period in the market. So just bear that in mind. So let's take a look at some of these peaks here when the VIX has really increased. We will have a look here at the 2008 peak, which we all know now looking back that this was of course the recession, the crash, the big crash of 2008. Obviously, at the time, an investor didn't know what was going to happen. I guess what we're trying to establish is whether the VIX would have been a good indicator of what the market was about to do. We'd expect to see that the VIX would go up, and then very shortly after, the S&P 500 would fall, because with a lot of fear and market stress comes sell-off and stock prices going down. And we can see pretty much a picture-perfect image of that right here. In 2008, that period of time, we can see that the VIX indicator shot right up, and of course the S&P 500 fell exactly corresponding to that. We can see that happen a fair few times here if we look at some other peaks. For example, this one here, I think that looks to be around 1999, just before. Again, the blue line went up, the orange line fell. It's what we'd expect to see. You can see that generally speaking, it is a pretty decent indicator, and it does show volatility during times looking back now when we would have expected to see volatility. So for example, we would have expected to see volatility during the recent crash that we had when we had the outbreak, and we've had, other big financial crashes in the past. You can see here, it's indicated again of the 2007-2008 global financial crisis. And more recently as well, I can't say the words in case this video gets demonetized, but you know what I'm talking about, it's on the screen. And we can see that the VIX is showing exactly what we'd expect it to show. It's going up. The measure is going up when there is a market financial situation of stress. So this all looks pretty good, and so far it seems like the VIX is the perfect indicator of upcoming market stress, and it may be a buy signal. But of course we must assess the reliability of this. According to a study, the VIX consistently overestimates actual volatility in normal times, but it underestimates it in times of market crashes. So this could make it a little bit unsuitable if you're using it as your only way to know when to invest. While the VIX is widely used as an indicator of how the market is feeling, it doesn't really represent market risk, especially in the long term. It looks at what the market is doing right now. It can't really tell you what the market is going to do over any long-term period. So let's take a look and see what the VIX indicator is telling us right now. Right now, the VIX indicator is sitting at 31.36 as of the 7th of October. So it is above 30, which does suggest market volatility. So you could argue that just going by that, you could say that it's a buy signal, and perhaps now is a great time to buy in because lots of people are fearful. Therefore, you should be greedy. Having said that, however, looking at this graph here, it's clear that a reading of just above 30 is not crazy. Like, it's not showing the same indications that we've had when we've had market crashes before. It's definitely nowhere near what it was during 2020 when it was right up here at 66.04, around about. I can't get my cursor to be spot on. Nor here in 2008 when it came all the way up to nearly 80. So although there's a bit of an indicator there, it's not peaking like mad. So this begs the question, is it worth even using this indicator? I do think it's interesting, and I think it's a pretty good indicator of market volatility, but it does encourage this idea of timing the market, which we all know can lead to some unfavorable results. For short-term traders, market volatility does provide this perfect opportunity for larger gains, but of course, also losses. It also allows investors to take advantage of low share prices and gives them the chance to buy the dip. Investors can instead manage volatility just by long-term investing, as this will help smooth any highs and any lows, and instead they won't need to try and time the market. If you use this indicator yourself, or even if this is the first time that you're hearing about it, do let me know your thoughts.